First rates on your screen. Friday morning, 77 points higher for the Nifty. And for the Bank Nifty also, it is an equally strong charged up start. So both the benchmark indices are off to a good charged up start. I'm just going to scan through my top traded screen here. First, you want to start with the obvious names here. Zomato. Where is Zomato? Okay, 91.5 for Zomato, 4.5 rupees higher. So this one is going to be on a tear. Second, let's look at the rub-off effect of Zomato on Policybazaar, on Paytm, on delivery, on Nykaa. Is Zomato having a rub-off effect on Policybazaar? Yes, 380 has become 730, Paytm 23 rupees higher, and then you flip it around with what do you have in delivery and Nykaa. Let's look at it. Now let's look at the numbers which came yesterday after the bell. Eicher Motors tell a set of numbers. Mahindra and Mahindra, however, ahead of the numbers. Where is that stock headed? Let's look at it. Mahindra and Mahindra ahead of numbers, 18 rupees higher, and SBI ahead of numbers. Let's look at that as well, just to establish facts for our viewers here. SBI also is at 591. So, Nisha thought as much. I mean, while we are focusing on Zomato, everyone is saying that if Zomato can do it, others can also do it. And that, I think, is a rub-off effect. I mean, they always say there's a rub-off effect. I think the real word rub-off effect, I've learned this word in actually markets, rub-off effect. And I think the rub-off effect, I think, is there in other stocks also.
Oh, well, yes, but Zomato itself is seeing quite a bit of spike. It's built on gains around 7.5% now, so there's no stopping Zomato today. Almost an 8% gain coming in there. But separately, look at the entire advance decline ratio. Very, very healthy. It's 1,500 stocks advancing to almost 200 stocks declining, and most of the sectors are actually in the green. Of course, it's been led by the metals pack, given the move that we are seeing on Hindalco on account of Novelis numbers coming in. Autos is also seeing quite a bit of bounce back because Eicher Motors starts with a gain of 2.5% on account of its earnings. And then you have Pharma also, which is up in the green. That's because Cipla is seeing the reaction of reports regarding Blackstone buying out the promoter stake. You also have a positive reaction coming in on the earnings for the likes of Lupin, etc. So we are watching out for this entire space. What else is happening in the market? But Dabur, that one is also inching higher, 3.5%. And we were talking about M&M ahead of its earnings. Let's pull up RBL Bank, because that stock is actually tanking. It's down, 3 or 4% as we speak. So RBL Bank is surprising. Okay, it's now just down about 2.5%, but nonetheless a slide coming in there. There's also Kansai Nerolac, which is up 3%. Dabur is up 3%. Paytm, on account of that July data that has come, plus the rub-off impact of Zomato is higher by 3%. Karnataka Bank and other names like Keystone Realtors and Dixon Tech really continue the move on the upside. So a lot of stocks which are in the news. But what are the top trades coming in from our chartists, and given the kind of open, what is the trade that they're punching right now? Kunal, you go first.
So attractive start for the markets. The 90,500 call is now almost at 100 rupees for the index. The Bank Nifty premium is dropped down to 150 points, but we'll see in the next 15 minutes whether the index premium shoots up yet again or not. On the stock specific front, Bajaj Finserv is something which looks attractive. The stock has corrected by 10% in the last 2 weeks or so and come back into an oversold territory. So we would expect a reasonable bounce from current levels.
Nuresh, what about you? What's the first trade that you are punching in, like any new age tech name?
You see a very old age name which is eventually setting up for a breakout. So keeping a stop below 165 and taking it as a positional bet.
Harsha Padhya joins us. Let's connect with him. Let's understand that what he makes of the market right now. What about risk-reward ratios and other global factors? Harsha, good morning. Thank you for joining us. So far, so good. So far, so good. Do you think for the rest of the year also it would be dominated by bulls?
Good morning, Nikunj. Clearly, I think if you look at the markets, the flows have been very, very strong. If you look at last 4 or 5 trading sessions, probably they have been a little weak, but otherwise for the past 4 or 5 months, we have seen very strong flows from foreign shows. The domestic flows have been very, very sticky and growing as well. So to that extent, no issues on the flows. Yes, there will be ups and downs in between, but overall, I think India seems to be getting reasonable attention from everywhere. As far as earnings are concerned, clearly for the set of companies that have announced results until now, there have been lesser disappointments than in line or better than expectation kind of results. So to that extent, even the earnings season has held up quite nicely as compared to expectations. The only thing that one needs to worry is the valuations have moved up above comfort levels. They are not very, very expensive, but yes, in some pockets they are expensive. And overall, they are well above fair range of valuations. So to that extent, every now and then you are going to see some volatility in the market over the next few quarters, that's for sure. Sustenance of higher levels and higher valuations will be dependent on flows as well as delivery of earnings.
One company which has delivered is Zomato. For a company where we thought that there would be a fat loss, they've delivered a smart profit. Other fintech and consumer tech companies are also, in a sense, talking about a clear guide towards path to profitability. So do you think now the narrative for some of these new age fintech, consumer tech companies, it needs to be changed? Because a year ago the narrative was that, okay, growth is there, but where are the cash flows? Where are the profits? Now it has turned. Now it has changed.
Clearly, whenever you see path to profitability becoming visible, definitely markets will reward that particular company or business. So I think that's going to happen across this space. Today maybe it's driven by one of the results and the entire sector or the entire segment is up. But one needs to be careful in terms of seeing whether all the companies are going to go in the same mode or are there going to be differences in terms of the path to profitability. We have also seen various other issues in some of these companies. For example, consistent selling from existing set of investors, which remains an overhang for many companies there. We have also seen many of the earlier set of management teams getting replaced or getting changed. So that's also something that one needs to keep in mind. And overall, you need to look at the overall business model and take a call. But yes, I think from the kind of negative sentiments that the entire segment had maybe a couple of quarters earlier to today, there has been a significant change, and that's a positive.
Point taken, but the other space which has seen a very good set of earnings, at least compared to the expectations, and has seen a bit of a re-rating of sorts, is pharma, right? Today as well, Cipla is high by 5%. A lot of other names are doing all right. What's your view on pharma?
Pharma continues to be a defensive bet, but unfortunately, there is no single sector-wide trigger, either positive or negative for the sector. So to that extent, we will have to evaluate stocks from a bottom-up perspective and then take a call. Yes, in a market which has gone up quite well in the last 4 or 5 months, we have not seen pharma really participating to that extent. And anyways, pharma has been an underperformer for the last couple of years as well. So to that extent, there is a relative valuation comfort there, but there is no single trigger that can take the entire sector up in our view. So you will have to evaluate them separately.
230, about 300 points higher for the Sensex. I think we are coming back and we are now looking quite stable. I look at the auto space, Harsha, it's been on a tear. Even the auto companies have come out with okay set of numbers. Two-wheelers are under pressure. Margins have not really come back. There's intense competition in the sedan market. What drives this sudden love affair of markets with autos now?
Well, it's everyone knows that it's a cyclical sector. So to that extent, you may not wait for entire positives to really become visible. And we do know that that the pipeline in terms of product launches has been strong. We have also seen very good launches in the recent past, which have evinced good interest from customers. We are seeing moderation in inflation across the board, which is going to come through in terms of profitability by lower input costs. We have also seen some of the other issues which were kind of an overhang for the sector, for example, availability of chips, etc., also getting slightly better in terms of the overall situation. So we believe that this is one sector which will continue to grow at a pace which is higher than the market average earnings growth. So to that extent, I think this can continue to outperform. But yes, in the immediate short term, just like many other sectors in the market, there is no opportunity in terms of the pure valuation in any of the sectors. So one has to be keeping that in mind and take positions. And the positions have to be from a medium to long-term perspective rather than what's going to happen over the next one.
You liked cement in the past and you've said, look, the cash flows in the cement sector are getting better. It is a sector where pricing power should improve. But the reverse is at play. Even though decent consolidation has happened after the Adani's entry into ACC and Ambuja, I looked at the numbers from Dalmia, even for that matter, Ultratech. They don't look impressive. Why is cement not coming back? Even the economy is growing, roads are getting built. Look around us, we both live in Bombay. It takes, 45 minutes for you to reach office. It takes me 1 hour sometimes to reach home. It's only because of the construction.
See, clearly demand has continued to remain strong, but we have not seen price growth, as you rightly mentioned. But we should also look at how costs have moved down in this sector. So net, I think there is going to be benefit in terms of profitability for the entire sector. It may not have been visible in the recent quarters because there is a lag impact between how raw material costs or input costs behave and what happens in terms of the P&L in the companies. So we expect that in the September to December quarter, somewhere you will see a significant improvement in the profitability of the cement companies. As you rightly mentioned, we have seen a huge consolidation, and it's not easy to put up new cement plants in our country. Right? There is a gestation period. There are a lack of availability of limestone, which is a key raw material. So overall, I don't think the incremental capacity is going to grow at a pace which is higher than the incremental demand. So to that extent, a consolidated industry structure and input costs, which are definitely coming down over the next few quarters, definitely remain a positive. And that's what we are excited about in this particular industry. It may not have showed up in the June quarter, as you rightly mentioned, but clearly September and December are going to be much better for this sector.
Harsha, what's the view on the entire capital goods space? And I'm talking about the broader, theme here, right from industrials, likes of ABB, Siemens, to defense names, to this entire electronic manufacturing, sector. Given the fact we have seen a lot of government push for indigenization as well, would you still look at positively the likes of Keynes, Dixon, despite the expensive valuations?
See, the entire industrial space has run up quite significantly over the last couple of quarters. So valuations don't leave too much of comfort at this point of time when you actually look at the immediate short term. However, if you look at the long-term growth is going to be very, very strong for this sector, either driven by the kind of capex that we are going to see in the economy or due to the kind of indigenization levels that are going to increase in the defense, for example. So various factors. One, you're going to see significantly higher level of growth over the next 5-year block as compared to past 5 years. And margins should also improve as you get higher scale, as well as commodity costs moderating in the recent times. So overall, this sector will definitely deliver much better earnings growth as compared to its own history, as well as compared to the market. But the question is whether you are comfortable about the valuations. I would rather say that you may not be comfortable with the valuations of the entire sector here, but there are still opportunities. One has to be carefully looking at it. I don't think at these kind of valuations, whether it is for capital goods or for any other sector, there is going to be a uniform rally across the sector. I think the rally will shift towards stock specific in nature. So to that extent, I am repeating myself, whatever is true for the market in terms of earnings delivery and the flows would be critical for this sector also to sustain current valuation levels.
The valuations are not entirely cheap, at least in the near term, and one needs to watch out for how this progresses. But Harsha, what's your view regarding large cap versus mid caps? Because of course there were a couple of funds that stopped the flow into the mid cap, saying that it's getting difficult to deploy the money there. How are you viewing the entire large cap versus mid cap universe?
Clearly, relative valuation comfort is much more in case of large cap basket. It's probably trading at about 19.5 to 20 times 1 year forward earnings, which is higher than the long-term average price to earnings multiple. But otherwise, you can't say that it's very, very expensive. But in some pockets of mid caps and small caps, especially those which are not so liquid, we have seen valuations reaching to quite alarming levels, I would say. So to that extent, yes, there is a bit of a caution that is required when you are entering in mid and small caps from a short-term perspective. If you are staggering your investments, if you are taking a 3 to 5 year call on this basket, yes, there is still money to be made, but definitely the volatility is going to be much higher in this basket as compared to large cap. So on a risk reward basis, I would say probably large caps are better placed.
What's the house view then with respect to the Nifty target? Do you think it's just going to get toppish around 20,000 if I can hold you to the levels there?
We really don't work with any targets on either stocks or Nifty levels, but clearly at these valuations, which are higher than long-term average, probably you're going to see a slightly lower market returns than the earnings growth. We are expecting about mid-teens kind of earnings growth over the next 2 years. So that should be affecting.
Okay. I just want to mark some stocks here, guys, and let's look at. No, I think Anisha is trying to whisper something.
Zomato is up 12%.
Why is it? Wow.
It's now inching towards 100. It's at 97. Let's pull up that. The 3-digit mark should happen on Zomato if the kind of run really continues. Look at that one.
Anisha, look, in markets, when the narrative changes, the approach also changes. And this is one stock where a lot of old timers have said, okay, these are companies which were burning cash because liquidity was easy and they had no pricing, they had no discipline. And the business model was all about giving a milkshake for free.
Yeah.
Along with the burger, because the milkshake was serviced by the private equity investor. Then came this entire compulsive selling by the funds, which is, at the beginning of the year where the P investors had to sell out, which created more supply. Now these businesses, at least not all of them, some of them have potential to grow and scope to run profitable. Now when you see a deadly combination of high growth and a profitable growth, then the narrative changes. I'm not so sure how, markets would value some of these businesses, but today I think markets are also enjoying the benefits of, the stock is enjoying the huge tailwind of what is called as a narrative change. A year ago there was a fat loss and now there is a smart profit. It largely because of cost efficiency and perhaps viability what they managed to create without burning a lot of cash, even though a lot of startups in the world actually have gone belly up. Look at what has happened to Bajaj. Mismanaged, $20 billion in terms of the most talked about startup in the world. It almost was more than a decathlon, right?
Yeah, it was. Yeah.
$20 billion. Yeah. And so that's the way how it is. Not everybody will survive, but the ones who will survive and the ones who will follow price discipline and are relevant to the market and to the customer, markets will always like them. That's Zomato for you. Very simple, 96 rupees. Manish Dangi is also ready and not ready, getting ready. But I can actually say thank you to Harsha for joining us. Harsha, thank you very much. I know it's a busy morning for you. A lot's happening and you managed to reach on time and find time. They both are important. I think reaching on time is more important these days in Bombay, right?
Very true, very true.
So how long is your office commute these days?
It depends on the time of the day.
So early morning, what, 40 minutes, 45 minutes?
Early morning, I usually leave early, so I take about 15 to 20 minutes.
Okay, wonderful. So we can actually call it 8 o'clock next time, now that you've given me a hint.
Yeah, maybe it works better.
All right, good to have you on the show. Thank you for joining us. Manish Dangi, good morning. How have you been, my friend?
Good morning, good morning. I'm good, man. How are you?
All well, all well. Haven't spoken to you in a while. Where are you joining us from? Because every time you join us from some exotic location. Sometimes it is Rajasthan, sometimes it is a holiday home. Looks like this is your office, your house.
Yeah, it's sort of office.
Okay. How you been otherwise?
All good, man.
Okay. When we spoke to you last, you said that you were all in. You were buying perhaps the biggest risk-on trade, which has worked like a charm for you, to buy US tech stocks. Nasdaq is up 44% this year. Good call. Now what's next?
So in India, Nikunj, as I wrote to some of my friends, and I think even to you, that it's incidental that we're talking today because it's the second anniversary of me turning bearish on Indian assets, and you gave me an opportunity to talk about it in 2021, and I was sort of both bearish on bonds and equities as well as Indian currency then, and what have markets done in this period in last 2 years is actually 0% in US dollar. And so whatever you sort of earn, about 12-13% is because of currency depreciation, and you would have earned as much in fixed deposits. So there is absolutely no risk premium available, is what I argued then in 2021. Now, lesson, of course, first for last 2 years is for anyone and everyone is that unless you solve for both macro and valuations, don't dial risk. The question, of course, what you now ask is, has the setup changed, and is there something to be extracted from markets now? Macro is, of course, a lot better today. CAD, currency, crude, rates, everything is, super good as far as India is concerned. As you said, US equities had become sort of super cheap December, and we all dialed it, made money. But that was a trade, is done and dusted now. We exited last week. Now you're actually looking at a recession cliff. earnings cliff in US. Indian valuations are anything but cheap even now, Nikunj, and Indian economy is anything but shining. It is shining on TV screens, but it's okay. It's a mediocre growth profile that India has right now, and you can't pay top decile valuation, which you're paying right now in India, and hope to have insurance bundled in. So macro is decent, but because of that, macro big sell-off won't happen, but returns would be pretty much same that you earned in last 2 years. Very mediocre, very little in dollar terms, very, very little, so to say. So that's what I think, Nikon, in a big picture sense.
Now, since you are an asset allocator, you look at macros and then you decide the next course of action. Give us a flavor of short term. When I say short term, 3 months. When I say medium term, 1 to 2 years. And when I say long term, 3 to 5 years. What, according to you, should be a good asset allocation? Short term, medium term, long term?
See, a very long term, I'll start because an easy one. It's very likely that you'll have sort of a garden variety recession in US in next 6 to 9 months time. And after that, it'll be fine there. India is likely to decent, very likely a 6% real growth and 5-6% of inflation. So 11-12%. Is a bit expensive, and which is why it returns overall would not be that great, but still would be double digit most likely over the next 5-10 years. So that's long term. Short term, very difficult to call. I just called last week that S&P 500 is peaked, and if you consider that S&P and Nifty actually correlate, even in last decade they would have correlated about 90%. So the all calls of decoupling and all have been sort of course, super wrong. And, so to that extent, if I'm lucky and, got the S&P 500 call right, then it's very likely that the short term looks very wobbly and bad. Then there is sort of a more, nuanced, a medium term outlook that you could build for an investor, and that is 1 to 3 years. It's likely that in next 6 months time, markets would get busy now. That yes, the much called recession since 2021 is actually now arriving. Tight financial conditions in US, especially how much rates have risen there. As the consumer actually or household run out of the savings of fiscal largesse, it's likely that he would actually tighten the purse, and he or she. So therefore, I think, US would get into some bit of a recession, and that's never a good news. I actually argued last week why every recession on average actually leads to about 20-21% earnings reductions. So in medium term, which is, at least 6 to 9 months out, or, if there is a recession and therefore a year out earning decline, I think it sort of makes sense to, even in US, which otherwise has become now expensive, it sort of take the chips off and be careful. And I think you will, in all sorts of markets, India may not correct as much because Indian macro is decent and earnings may not decline. But Indian earnings may not rise. Indians are baking in about 40% increase, Nikunj, and it's very unlikely that you will get disappointment. The 40% increase in next 2 years won't likely come. So I think in medium term, the returns are going to be somewhat more moderate than the long-term expectations of yours, is what I would sort of argue for the investors.
Hi Manish, this is Anish also joining in the conversation. So you said you've exited the US market last week. You're saying that Indian markets are still a bit expensive and there are still issues, as far as the market is concerned. So where should one look at deploying the incremental money? What are you doing?
Look, for the pure macro guy, there's an opportunity arriving. I've been a bond bear since 2021. I've made this argument on your channel many times, but it's done now. It's a very, very significant, almost, once in a history sort of tightening has played out in US, and US treasuries 10 years are trading at about 415, 420. And I think there's an opportunity there. So for a big macro allocator who have an access to US markets, I think an opportunity in next couple of weeks time to sort of dial US treasury if you're actually now starting to build a US recession view. Indian bonds actually still some time away, but I argued on his channel that, this short term 1 to 3 years actually look decent, and that's where you can be overweight. Indian markets, of course, because, it's one of those markets where the likely earnings will not fall off the cliff in a significant manner. you could still be relative to US now. I'm making just the opposite argument what I did in December. Relative to US, you could be actually overweight India. So that's how an asset allocator, would actually, it's a jigsaw puzzle, you keep moving few things here and there to go overweight and underweight. So that's how I would look at, a little bit of a long short bonds in India, long US treasuries in next few weeks. And within India versus US, you would look at India more favorably versus US right now. But again, in absolute terms, you will have to be underweight equities because equities both in India and US actually are pretty expensive.
Okay. Now, for our viewers here, Manish, who do not have the liberty or understanding or the wherewith to, let's say, buy into US bonds or invest in US tech stocks, they won't understand what to do in India. So, if a simple allocation perhaps for Indian investors and our viewers is FD, cash or FNO. These are the three things in which they move. So, are you saying that it's time to hunker down some equity exposure, move it back into a government paper or perhaps into a fixed deposit?
So, Nicholas, I'll tell you something more interesting, which I told some students last week, which is sort of, I think investors should look to increase surface area, all sorts of investors. We're very likely talking to someone right now on your TV show who is already fully invested in Indian equities and are anxious as to, why everyone, prices are not going up. I think, we should guide him to add at least two more assets, Indian bonds and Indian US equities. Then we want to all reach out to people, both me, you and asset gatherers want to reach out to the ones who actually you talked about, which are predisposed towards only fixed deposits. And FDs are not only assets in the world, and they should add, of course, local equities or international equities. So in a sense, because, the key point is that the markets are intrinsically cyclical. No story, including that of India, is secular. Chasing past performance never helps. By increasing the surface area, investors are increasing the chances that, they will get some opportunities and, that will help them avoid the fear of missing out in any particular asset class. So the one-trick ponies, Nikunj, who perpetuate the myth that there is no other option but Indian equities, do so because they don't have other tricks up their sleeves. And that's true even for the fixed deposit, the fear mongers. So I guess increase the surface area, have these assets sort of at least know them and, as and when they're cheap, dial them is how a broad big picture view I'll try and tell today on your show. Yes, to the people who are predisposed towards FDs, I think, mutual funds in the fixed income space are giving decent returns. And you should, and, it's not a absolute undialed time for Indian equities. If you're absolutely zero in equities, you should continue to add through SIP or some systematic route, buying local indices or diversified fund.
Okay. Manish, what would be the importance of next year's election cycle for absolute asset allocation? Because there would be a swing factor which could be at play.
Yeah. Nikhil, of course, when I worked in a corporate, the first thing, we were told is I never talk politics on a TV show. But I don't work with a corporate, so I would sort of take the liberty actually to call it out, which I've shared with you that, I think on politics, at least what we could say for sure, that markets are mispricing uncertainty associated with it, at least, I don't know which way it will lean, but how certain that markets are of the kind of government that it wishes, and the kind of the government which it wishes that will support a general stuff like what we've got, which is tax cuts and such, and less redistribution, more infrastructure. It's very likely that next 5 years, at our 2024 onwards, you will get a different form of government. Could be incumbents return, could be sort of another coalition takes place. But in any case, the mandate would be different than that of 2019. And to that extent, I think people are underpricing, both in bonds and equities, the risk associated with Indian polity. It sort of swings from one direction to another, Nikunj. And we've had a government, which is sort of, which actually favored infrastructure over redistribution, much like people talk about Modi as more of a socialist. He's been a pretty sort of capitalist guy. So I think it's likely that the form of government, which changes every 10 years, at least in ideological leaning terms, I think it would change. And that actually is not good for financial markets. It perhaps is relatively better for real assets.
Janki, always a pleasure to have you on ET now, and certainly hope to see much more of you going forward.
Thank you.
That was Manish Dangi on what should be the right asset allocation, and the asset allocation could be a function of what your risk appetite is, but in general he's of the view that you should hunker down your return expectations and diversify. And typically in India you do either FD or FNO, which is that no risk or FNO risk. You got to diversify by buying bonds, you got to diversify by adding more US equities also in your portfolio. Markets meanwhile, Zomato is turning out to be the big story. It is the big story for this morning. Apart from Zomato, you've got, Raymond is nearing 2000. That's not bad. I was looking at the data in terms of, where else the price action seems to be moving. The price action is firmly in favor of Cipla after the Economic Times report on what could happen to a promoter stake sale. And then you've got good old IRFC, which has done rather well for itself. It is up some 32% this week. Super outperformance relative to the Nifty. Change gears and connect with Rajiv Rajgopal, Managing Director with AkzoNobel. Rajiv, good morning. Thank you for joining us. Now, when we spoke to you last time, you were talking about the challenges in the sector, largely because of inflation and what was happening because of the rural demand. How has the construct for you? How has the quarter been for you?
Good morning, Nikunj, and good morning to all our viewers watching ET now. Look, as far as the last quarter is concerned, we reported our numbers. We've reported close to about a 7% growth. What we've seen is two things, Nikunj. A bit of a K-shaped sort of a recovery where we are seeing a higher consumption of premium and really surprised, really a large part of it really coming from our rural tier 3, tier 4 towns. In my view, if you look at the strategy that we have really embarked upon, and we are going to really take it to the next level for the strategy period 24 to 26, is really focusing and dialing up our premium portfolio, because that's really what sort of makes sure that we are able to play profitability and make sure that we are able to invest behind our resources while focusing on adjacencies in the paints part and also dialing up our distribution on the paints part. Our coatings business have done very well. Obviously, I was watching your earlier show, and really infrastructure seems to be really having a huge uptick, and certain vectors that you really look at, whether it's the dialing back of the real estate, etc., has obviously lent itself to our coatings business doing well. Automotive has had a great quarter. I think you also reported the results of many of the players. And obviously, wherever we play, we don't play in the OEM, but in the aftermarket, we are seeing a very high double-digit growth. We also see it in some of our segments like powder and marine and protective. So all in all, it's been a bit sort of a tough quarter, because really we were hoping to get close to double-digit. But really, when you look at all the players, we are pretty much there. We continue to hold our market position. And for us, really, it's about really building the roadmap and making sure we start moving to becoming the fastest players in the industry.
My next question is about, revenue growth 6%. But on your base, if I look at the revenue growth of 6%, absolutely good news. Relatively, some of your peers have got a much larger base. They've done similar growth numbers. I was hoping that on your base, the revenue growth number should be much higher. Is that a fair assessment?
That's a fair assessment. I think there are parts in the... So let me break it into paints and coatings. In the paints part of the portfolio, I think we've still got a lot of dial up to do on our mass market and our economy range, where we've seen a higher growth coming from the industry. In our coatings business, our industrial coatings had a one-off last year in the, where we had a huge order, which sort of obviously it's time-based, and that sort of got executed. And hence, there's a slight correction there. And also in some of our export orders, particularly to Sri Lanka and Bangladesh in that business, there is a bit of work that had to happen there. But I'm fairly confident going forward. The teams are sort of working on it, and hopefully in the quarters ahead, we should be able to start seeing, again, moving up. Nikunj, if you look at the last fiscal, we had the AGM yesterday, and we were pretty pleased because it's after many years, we've really become, in the top 2 in terms of incremental growth. So from our perspective, you're absolutely right. The focus is really saying, how can we continue to be the the top 2 in terms of growth? And that's where we are really focused on.
Rajiv, you said you were trying for double-digit growth, but it was a bit disappointing that you couldn't achieve in this quarter. But as we head into Q2, Q3, which are seasonally better, do you expect that double-digit growth to play out?
So, Anisha, I think it'll take a bit of time. See, Q3, if you really look at it's a bit of a quarter where some of our large geographies in the month of July have slightly got impacted with the monsoon excess that happened. But yes, I think from a trajectory perspective, I do see that we start moving in. I'm certain that between Q3 and Q4, we will start seeing the growth really come back, because fundamentally, I think the enablers have put in place and some of the strategies seem to be working, which clearly also was reflected in the current quarter. If you look at our coatings business, we seem to we've got a very good order book, which is coming across most segments. Even in our projects business and paints, we've got a good order book. So hopefully we are fairly confident that we should be able to sort of make sure that we start sort of living up to our promise of moving to the top two in terms of incremental growth.
Rajiv, everybody is now curious to understand that there is Grasim and there is Jindal. Has the industry started feeling the heat of intense competition or increased competition or new entrants?
So, Nikunj, look, I think let me take the Grasim a little later. I think let's first look at the current construct. I mean, we've got players who've come in. There are players who obviously are doing well. But that said, if you really look at it from the last, almost about 12 quarters, I think the incremental growth of the top four players have sort of only got strengthened in a way. So to me, I think in a paints business, I think building brand distribution, having an efficient supply chain, etc., are strong levers. You also work with an applicator. Yeah, you work with a painter contractor, so that relationship and making sure you sort of dial it, using digital as a platform for driving efficiency and costs, etc., are also key enablers. So I don't want to get into specific company and sort of talk about it, but suffice to say that, look, other than an odd player, we've not seen too much of traction of players who've launched in the markets that they had already launched in terms of sales from existing outlets, and that's where we've been able to bounce back. If you look at the last 5-6 quarters, every quarter has been a record. So that clearly tells you the first part. Now, in terms of the newcomer into the industry, I think we'll have to wait and watch. We'll have to see what the play is. Of course, it's a formidable player in the industries that they have taken part in. But we've already working on a strategy. From our perspective, we've got a very high market share in the paints business in terms of, and they're largely entering into the paints business in the premium segment where brand Dulux, for consumers who use brand Dulux, Nikunj, I'm sure those of you who use and you use Dulux will say that, look, it's a terrific paint to use at home. I think the challenge for us is really how do we sort of dial it up? How do we dial up our brands much more and get entrenched into the minds of the user? And that's what we are working on. So what are we doing? We are going to be launching in a few weeks our Dulux Assurance 2.0, where we are reinforcing the quality of our products by giving a warranty of about 5 years. And there is obviously certain conditions that would apply, but really we are dialing up the quality because we genuinely think that we are the best in class in quality in the industry on the paints and coatings that we offer to our customers and consumers.
Rajiv, sorry, just to interject there, I think what Nikunj was trying to ask you was with respect to the increased competition, how will the margins pan out given the fact you're making new launches? All of that will need a lot of investment in your advertising spend as well. Crude prices are no longer as benign as they were. Of course, increased competition coming in. All of this, what does it do to your margins?
So look, I think from a margins perspective, I've stated that we would be at double-digit margins. I think both from India perspective and from a global perspective, I think we're very clear that our focus is really going to be to make sure that we hold and start growing our market share without diluting our margins too much. What do I really mean? We are at a comfortable double-digit margins over the last few years. We want to hold that, so we don't want to sort of reduce that. And there we are working on a lot of cost-effective programs where we are looking at efficiencies in our supply chain. We are looking at digital. We brought IoT into our factories to drive productivity. So really, margin management and productivity are two big themes we are working on to make sure that we are able to fight the battle. Now, look, if there is a price war, of course, certain assumptions will change. So that's another assumption that we are working on. So we are doing a scenario building, and in the scenarios, let's assume it's an extreme, which is assuming a significant price difference between a new player and us. Again, we'll have to see what that means. We had a player who came with a proposition which in a way was trying to erode margins. But if you look at the last few quarters, nothing has changed. I mean, our margins have held, and in fact, better. So even if I were to take out the easing of the raw material or the softening of the raw materials, which has come in the last couple of quarters, the underlying margins are still very strong. So we are doing scenario building, Anisha, and I think I would be in a better position to answer this question maybe in a couple of quarters when we get to understand what exactly the proposition that the new entrant is likely to bring in.
Okay. Well, Rajiv, appreciate your time. Thank you so very much for joining us. It's turning out to be a good day for Dabur. It started 5% higher, not holding on to the day's gains, but still 3% higher after all that nonsense which happened in social media about their honey and there's honey having some cancerous properties. Stock market, sometimes they react to funny things. That's what I can say. And that's what happened to Dabur stock yesterday. All right, Sahil Vachani joins us, Managing Director and CEO of Max Ventures and Max Estates. Let's understand from him how's business going. Noida, Gurgaon, NCR region is where real estate is in a strong uptrend. Sahil, good morning. How are things?
Good morning. Thank you for having me here. All very well. Thank you.
Let's understand the thought behind this change. It is just a change of the name by merging it with a subsidiary. Was there a need to do this?
Yes. So the idea was to be able to directly list Max Estates and take away the holding company structure. If you recall, when we had Max Ventures and Industries, we had the packaging business as a subsidiary. So there was a packaging business and the real estate business. With our exit of the packaging business, complete exit to our erstwhile partners, Topan, we have now become a pure play real estate focused player. And the idea was to directly list the real estate company and therefore remove the holding company structure, so to speak. So Max Estates now directly gets listed. Of course, the name will change to reflect the nature of our business. And as an offering, it's a pure play real estate development company focused on the National Capital Region.
For existing shareholders of Max Ventures, nothing changes. It's just the name changes technically.
Yes, technically, it's just a merger between the listed company and its operating company. So the name changes and also one layer of corporate structure goes away. So Max Estates now becomes directly listed.
For an existing shareholder, there would be entire process, NCLT approval, which I think you've already got. And then there would be a period when the stock has to compulsory go off the grid. It will be delisted for some time, I'm assuming.
That's correct. It will be delisted for about 30 to 45 days. And I think the record date is 11th of August, if I'm not mistaken. Yes.
Now let's talk about the launches. When I look at the numbers, the NCR, the Gurgaon and the Noida launch, it's just looking fabulous for Max. Our numbers are indicating that the company is on course to make at least 1,500 crores of EBITDA from the Noida project and a similar number from the Gurgaon project in next 3 to 3.5 years, which means we are looking at about 2.5 to 3,000 crores of EBITDA in next 3 to 4 years. Am I conservative? Am I realistic? Am I wrong?
I don't think I'll be able to comment on the forward-looking number statement per se, but I think what we have, what I can share is what we have disclosed is the fact that we have recorded 1,800 crores of sale from our project in Noida. We are going to be expected to launch our Gurgaon project at some point next year. We have close to 2.5 million square feet in Gurgaon. It's going to be an intergenerational campus there. In addition to that, we also have our commercial office portfolio, which is 3 ready assets today, which is Max Towers in Noida, Max Square in Noida, and Max House in Delhi. And we have about 3 million square feet of underdeveloped office space that's happening between Noida and Gurgaon. So as a footprint, we'll have a total footprint of about 8 million square feet. And we are seriously looking at more growth opportunities as well as we go along.
So let's get the maths here. You've launched a project in Greater Noida and you've launched a project in Gurgaon. And you are looking at 1800 crore of booking you've done in Greater Noida, right?
The project is in Noida, Sector 128 in Noida.
Okay.
Yes, we've done 1800 crores of booking there.
And what about Gurgaon?
Gurgaon, we are anticipating to launch next year, and the total size is about 2.5 million. And we are yet to decide, how will we phase it out. But closer to the time, we'll be able to share a revenue guidance. But at this stage, it's difficult to give a revenue number. But the size is quite significant. To put it in context, Noida was 1 million square feet, and Gurgaon is close to 2.5 million square feet.
I mean, a similar construction with a similar quality at what it has been sold. I'll do my numbers after that.
Sorry?
No, if in that region, real estate region, a similar construction of a similar quality, what is the ongoing market price?
So current market price in Gurgaon is close to 15 to 16,000 rupees a square foot.
I believe that it will be close to that. I'm putting maths together. I'm not asking for a forward-looking guidance here. I'm putting maths together here. Okay, I can't hear him or he's not answering.
No, I can. Yeah, please go ahead.
No, okay. Now let's understand the Noida project. 1800 crore is what you've booked. How much profit are you likely to make? How many flats are there? And what kind of revenue recognition policy are you likely to follow?
So we have a total of 201 units. They are mostly 4-bedroom and 4.5 bedrooms, so to speak. The revenue recognition policy that we will follow is basically to record it at the time of completion. So over the next 2 or 3 years, it will take us about 3.5 or 4 years to complete as per the RERA timelines that we have committed. So on completion, we will be able to record 100% of the revenue. There will be some cost that does not get recorded at that time, but gets recorded in this current fiscal year and in the next year, which is some marketing, brokerage, which we are not able to match basis accounting policy to the revenue at that time. So it's about 1,800 crores of revenue, and to put it in context, we paid about 350 crores for the land.
Sahil, we've talked about your residential portfolio at greater detail, but what about the commercial portfolio? Do you have a slew of launches lined up there as well, or you're going a bit slow, given the fact that you're focusing on residential right now?
No, commercial has been actually our core strength as well, and we don't sell the commercial portfolio. We build to lease it. So we are 100% occupied across Max Towers, Max House, which are at about 25 to 30% premium to the micro market. And we've just launched Max Square that's coming into the market today to start leasing. And we are seeing good traction for that as well. In addition to that, we already have about 3 million square feet of office space, or 1.5 million in Noida that we are starting to build now, and 1.6 million in Golf Course Extension Road in Gurgaon that has started development. So we will have a very strong commercial portfolio spread across Delhi, Noida, Gurgaon, and across the various micro markets, in addition to the residential pipeline as well.
So you talked about the occupancy levels being higher, plus the launch pipeline in terms of the commercial business as well. But in terms of the realizations and rentals, how's that moving in terms of a year-on-year move? What kind of uptick are you seeing there?
We are seeing actually very high levels of occupancy. We are 100% occupied, and not only that, but the work back from office trend we are seeing is very strong. People are coming back into the office. So we are seeing almost higher than pre-COVID levels of occupancy and tenant footfalls into the building. So the idea is that we are looking to scale this portfolio. The aspiration is to build grade A plus quality developments focused on amenities, an ecosystem, a lot of innovative spaces that give a reason for companies to come back to the office. And we are very bullish about the traction that we are seeing on the office space as well in the long term.
So broadly for FY24, what would be the commercial space which would have been leased out, locked, and where rental would have started, and how will that trajectory move, let's say, for next 2 years?
So we have close to 500,000 square feet that is 100% leased as we speak. We have another 600,000 square feet that's in the market for leasing as we speak, and there will be another 2.5 million square feet that will get added over the next 3 years. With the 500,000 square feet broadly that we have leased, we have approximately 100 crore top line of rental income. The aspiration is to be able to have a fully blended portfolio of rental income of close to 500 crores on a full blown out basis in the next 4 to 5 years.
And before we wrap, I'm going to ask you something which is of immense market curiosity. And we know that there are some, companies of the Max Group where the promoters are looking at reducing their stake, they are looking at reducing their leverage. What is the status on that? Because we keep on revisiting that every time I speak to some, common friends, some shareholders, they said that, look, we need clarity on that front.
I'm not going to be able to comment on that, but I can share that in the public domain, the sponsors have committed to be able to reducing the pledge across their main company, which is Max Financial Services. The other companies, which is Max Estates and Max India, are not. There's zero pledge in those entities. So at this stage, I can comment that there has been a commitment that the promoters have made, and they will definitely honor that.
Sanjay, I'm just reaffirming it again. There is no promoter pledge, and there are no cross holdings which need to be cleaned out.
Not in Max Estates or in Max India. That's just in Max Financial Services, which also, as I said, the promoter group has clarified that it will get leveraged and cleaned up very soon.
Final question: what is Sal Vachani's vision for Max Ventures then? I mean, where do you think the company should be in 3-5 years? Where do you want to take this company to?
I think that we are very clear. We want to be the top few preferred brands in the National Capital Region in real estate. I think the opportunity is there. The space is there for us. We have built a track record. We have got a strong balance sheet. We've built the team and we have the pipeline and opportunities. So I'm very hopeful and confident that we will be able to see Max Estates in the next few years as a top few real estate developers in the National Capital Region across the residential and commercial asset classes.
Okay, so with that vision, we'll let you go. Thank you so much, Sahil, for making time and speaking with the 18 hours. So talking about how looking at being one of the largest and the most critical player in the NCR region and has a big pipeline lined up both in terms of residential as well as commercial launches. Quickly taking stock of what's happening in the market right now, because the Nifty is building on to gains, I think, because it's just very close to that 19,500 mark the last time I checked. Okay, it's 19,450. It's Zomato that continues the uprun 10% higher. Dixon Tech, that's built on another gain of 8% after the 7-8% rally yesterday. And InfoEdge and Intellect Design, these are the two IT platform companies which are actually doing well in the trading session today. Talking about platform, it's also Policy Bazaar, which is inched higher by 5%. Paytm is reacting to the July data that has come in, plus the rub-off impact of course, Zomato. And lastly, Cipla, that's reacting to the reports of that deal, which is likely to happen with Blackstone. So that stock holding up with a gain of around 5%. But what's happening with Eicher? Because, of course, we got the earnings overnight and that looked quite impressive. So let's try and decode the behavior of the commercial vehicle segment there with Mr. Vinod Agarwal. He's the MD and CEO at Eicher VCV joining us on the show. Mr. Agarwal, hi, good morning. Thank you so much for making time. Well, what's the overall sales outlook for FY24 looking like in terms of commercial vehicles? Do you think it's likely to be better than financial year 23?
As of now, if you look at the commercial vehicle market, the industry, if you look at the industry, I think we have seen good growth in first 4 months in some of the segments. For example, the heavy duty trucks, they are growing by almost YTD basis around 13%. Similarly, buses are growing by 34%. However, there is major stress in exports out of the country. Exports have dropped significantly by 37%, and there is some drop in the light and medium duty trucks. So there is a mixed, you can say, performance as far as the industry is concerned. So overall, 3.5 ton and above industry, first 4 months has grown by 1.7%. As against this, at VCB, we have grown by 8.5%. So therefore, we have outperformed the industry. Our market shares have improved, and we are expecting that the balance 8 months for the industry are going to be good, because there are various reasons why the industry will do better. First of all, I think monsoon is doing well, and because of that, rural economy is doing better. Apart from that, the infrastructure investments are continuing. and still there is a lot of pent-up replacement demand, because I think the trucks are due for replacements, because the new trucks which have been designed after BS6 and BS6 OBD2 norms, they are much more productive. Therefore, if you replace these old trucks, you can get better efficiency, you can get better costs. Therefore, it makes a lot of sense to replace these trucks, and that's what the customers are doing now. And you will see more and more replacements coming in. So therefore, based on the economy overall doing better, infrastructure investments, good monsoons, and replacement market, you will see good demand in the balance 8 months.
What are you gaining on domestic market? Are you likely to lose because of the drop in exports?
Exports, of course, is the one dampener, and large impact is coming from South Asian markets like Bangladesh, Nepal, and Sri Lanka. Bangladesh, that used to be almost 40 to 50% of the exports out of the country for commercial vehicles, has dropped by almost 70% plus. And similarly, the situation in Nepal. But on the other hand, good news is that the exports to Middle East, they are growing. And exports to African region, they are stable. They are, in fact, some countries are down, some countries are up. And overall, African region is relatively doing better. And then there are growing export regions like Southeast Asian markets or Latin American markets, where the exports have started happening from the country, and you will see more and more traction coming from these regions. So therefore, potential for exports continues to be very good, but current year exports right now they are under stress, and it is largely because of the foreign exchange situation in South Asian markets of Bangladesh and Nepal.
That gives us a good understanding of how things are panning out in the international geographies. But within India itself, there seems to be a sense that it's the higher discounting which is leading to the volume growth that we are seeing. And that's what at least we're hearing from ground reports. And perhaps that's the reason your margins have slipped on a quarter-on-quarter basis. Is that the correct understanding? And what's the discounting likely to be for the next couple of quarters?
In fact, on the discounting front, there has been improvement in the last quarter, because I think everyone in the industry has realized that discounting is not the right way of managing this market, because the type of discounts that were going on, those are not sustainable. Therefore, I think if you look at the industry performance as compared to the previous year quarter one, all across, everyone has improved on the margins. For example, our EBITDA margins, they are in the last quarter, they were at 7.5% as against around 5.5% in last year quarter one. Of course, you can say that there is a drop from quarter four, but quarter four is always a bumper quarter, and you get a lot of leveraging advantage in quarter four. However, overall price management has been better in quarter one. And going forward, it is expected that this pricing, the discounting should be better and better only. There should not be any further negative impact on account of discounting. On the other hand, we are seeing good softening in the commodity prices and overall supply chain scenario. So both inflation and supply chain, both are stabilized. So therefore, we are not expecting much cost pressures coming from inflation side. So therefore, I think overall, let's see, we should have a better position.
Will you be able to get into the double-digit margin range by the end of the year? Because last year, what you did last quarter, you did 10% thereabouts.
Last quarter, we did 7.5% EBITDA margin. It is very difficult to say that whether it will be double-digit or it will be. But if the volume goes up, which is likely to go up, because the second half is always better than the first half in the industry. So therefore, when the volumes will be more, you will get the leveraging advantage.
Agarwal, on that note, we'll let you go. Appreciate you joining us on the show. So the discounting is abating in the segment and overall growth looks healthy. That's the word coming in from Mr. Agarwal of Aisha ECV. But time now to slip into a very short break. Don't go anywhere.